I've made over $5.3 million trading crypto in the last 2 years. And if I lost everything tomorrow, all of my money, all of my experience, and all of my knowledge, this is the only video that I would need to watch to get back to 6 figures very quickly, because that's exactly what this is. It's a full 2-hour crypto trading course completely free with 8 years of knowledge broken down step by step so that you can go from a complete beginner to expert and making money in the markets very quickly. And how do I know that the strategy that I'm about to teach you works? Well, it's worked for my student Casper here, who within 3 months of using this strategy was able to buy a brand new BMW and pick up his dream car. Also, Novello here, she was a complete beginner. She came to me and she didn't even know what a candlestick was. And within 7 months, she produced 6 figures in profits and she was able to buy herself a brand new Rolex for Christmas. And the same here for Mrs. Chips. She came to me also as a complete beginner, and then she able to reach her goal of 7 figures within a single year of using this strategy. And this is what is possible when you understand what I'm about to teach you. And these are the results other people have produced, let alone myself, because 10 years ago, I used to be an engineer. And this is when I first discovered crypto back in 2017. As you can see here, I was playing around on GDAX a long time ago with 0.066 Bitcoin. Anyway, that was a long time ago now, and I was able to turn this small amount of $2,000 into over $5.1 million in a very short amount of time, probably around 2 to 3 years. And so what trades did I take to make this money? Well, I was able to short the exact top of the crypto markets in 2022. This proof is verifiable here. As you can see, this is one of my calls. This is the top 100%. I'm looking to buy ETH back at 1,000 and Bitcoin at 30,000. That was back in 2021, 15th of November. And as you can see here, I've decided in typical BTC fashion that it would print this kind of pattern, and it did exactly that. And then this was my verified Twitter call as well. This was on Ethereum. This was on December the 9th, 2021. So all of these results and all of these trades are verifiable online. But something happened. As you can see here, this is a quick story about me, and all of my funds here were on FTX. And as you probably know, if you were in crypto for a while now, FTX is an exchange that completely collapsed, and I had all of this money stolen from me. The reason why this money was on exchange is for a unique reason, and I have a whole video about that, as you can see on the screen right now. Also, I was left with 3,000 euros to my name, 3,000 euros. And so I posted every single trade to make it all back. Trades like this, where I called the exact bottom on Bitcoin in November 2022. This was my bottom call on Bitcoin. This shouldn't go below 16.5K. I was able to produce results like this and make P&L like $60,000 in a single trade. And then I eventually grew my portfolio back to over $5 million once again for the second time in my career. And as you can see here, this is me next to my flashy Aston Martin. So that is all of the results that is produced for my students and myself. So what is this crypto strategy? But before you can make money like this, you need to learn the foundation of crypto. What we're going to cover in this full course is what is crypto and how we can make money off of it, which coins to buy and how to pick them, when to buy and sell coins at the right time to avoid losses, how to sell the top of the bull market, and how to buy the bottom of a bull run before it starts. The different type of strategies you need to use to make money, how to grow a small crypto trading account, how to avoid scams and avoid losing money through these scams, and then my own personal advanced edge in the market that has made me millions of dollars. So we're going to go from chronological order, from beginner to more advanced concepts, and that's why you need to go through each topic and make sure you need to understand them correctly. So what is a cryptocurrency? And that is essentially decentralized digital money, aka finance. So what are the other options for finance, and why is crypto superior than the other options, such as a normal bank? Because if you have your money in a normal bank, your money sits in their system and they control it. They can freeze your account at any time. They can block your transactions. They question you why you want to spend your own money. If you want to withdraw even $10,000 worth of cash, they will go, why do you want to take this money out? And that's not to protect you and your capital. That's to protect them. They also take days to send payments because sometimes a bank transfer, if you send it on Friday, they're still shut on weekends, and then it needs to take 2 business days. So you have to wait the whole weekend, and then Monday, Tuesday, and then the payment is processed on Wednesday, which takes a whole bunch of time and is not efficient for you especially. Crypto is the complete opposite to this. There is no one telling you you're not allowed to send your money, and you can send as much money as you want as quickly as a small amount in a very fast way. Your funds cannot just be frozen from some bank or somebody who doesn't like you, just wants to freeze your capital, or you must show us these documents or your bank will be closed down. And you can send as much as you want to whoever you want, whenever you want, and it works 24/7. It hasn't shut down a single day since Bitcoin was created in 2008, and I'm going to go over that just shortly. And that's what decentralization and true freedom is like. And this is a little diagram of centralized versus decentralized. As you can see, this is a centralized network. There is one single entity in the middle controlling all of your funds or making all of the decisions. They control all of your funds. It's not anonymous. There is server downtime, i.e. our bank is shutting over this weekend. We need to do updates. I've had that on my banking app before, but the positive to this is that it is easy to adopt. A lot of people can join this network. Very easy. Then you have the decentralized network. That means there is a lot of people on the network. There is no single person controlling all of the money. You control your funds. It's completely anonymous. You don't know who this person is, this person is, this person is. The server is online 24/7. However, it is not easy to adopt the decentralized system. And this is the part where people don't really understand that crypto is actually safe, because every single transaction is documented online on a blockchain network. And so if you want to take control of Bitcoin, that means that you need to control over 51% of the entire network. That means you need to take over probably hundreds of thousands of computers spreading all over the world at the same time. And it needs to be at the same time, which is literally impossible. So that's crypto compared to the banking system. And then if you compare crypto to other investments, if you get into stocks, it's slow, and you need a lot of capital with 10 to 20% yearly gains if you're lucky. You may get 2 to 3x returns if you pick the right stock and spend a lot of time in this area. Real estate, you're going to need 6 figures up front, and it takes years to see returns in this area here. Drop shipping, there's too many moving parts. You need inventory, customer service nightmares, and you can get somebody to copy and paste your store and lose your edge very quickly if you don't build up a moat around your online store. If you want to make your own startup, like an AI company or any startup that you can sell in the future, this takes years because you need to build a project and you need to hire a team. And then hiring a team has a lot of costs, and therefore your costs eat into your profits before you do your exit at the end of it. But with crypto, you can work from anywhere in the world. I've traded from Dubai, Bali, all across Europe, and I've made 50 to 100% gains in a single day, starting with $2,000, as you can see my story earlier. And so that's why crypto is superior. And there are hundreds and thousands, if not millions of coins out there. So now I'm gonna cover which is the best coins to pick and how to pick them. And there are really 3 types of coins here in order for you to make a lot of money in this space, because obviously I could go to any altcoin and pick it out, but I'm gonna break it down step by step so you can pick the best coins at the right time each cycle, because it changes each cycle. If you've been in crypto for years, you will already know what Bitcoin is, but let me remind you why this is the greatest coin of all time, because Bitcoin was invented in 2008 and then created in 2009 by somebody called Satoshi, and nobody knows who Satoshi is. They are completely anonymous, and obviously the rumors of Jeffrey Epstein being Satoshi is completely false. But there will only ever be 21 million Bitcoin created. That means there are more Bitcoin in the world than there are millionaires. So even if you just get one, the likelihood of you becoming a millionaire is pretty high. And you cannot print more Bitcoin. And obviously, when people lose their 21 million Bitcoin, some people forget their seed phrases, it gets stuck in wallets, etc., etc. Obviously, then the supply decreases. And so you cannot just print more. Unlike any other currency, you can just print more dollars. The US government can just print as many dollars as they want, devaluing that currency. And gold, you can also mine gold. And if you find a a large cave with a lot of gold in. Obviously now you've increased the supply, which decreases the value of gold. But the supply is limited for Bitcoin, which creates scarcity. I'm gonna go over quickly how you can make a Bitcoin, but in order to create a single Bitcoin before we hit 21 million, because obviously there is only 21 million Bitcoin, you have to mine it. Because at the start, there wasn't 21 million Bitcoin in supply, and there still isn't 21 million Bitcoin in supply. You use computers that I mentioned earlier to solve complex equations. And then once the computer solves a complex equation, you get a reward. And every 4 years, the amount of Bitcoin you get for mining a single Bitcoin through this complex equation gets cut in half. So let's say if on the first halving, you get 1 whole Bitcoin, on the second halving, you only get half a Bitcoin for mining 1 Bitcoin into circulation. This is why it's called a halving, and it creates massive supply shock. Less Bitcoin enters the circulation until there are 21 million coins out there. However, the demand for one of these orange Bitcoins keeps on growing. And as you can see, every single time here we've had a halving, this is what happens. 2012, you get the big boom. 2016, you get the big boom. And 2020, you get the big boom. And then in 2024, we did get a big boom from here, 46,000 all the way up to 120,000. So it's still a 3x from that. And this is one of the reasons why Bitcoin is going to keep going higher longer term, and it's not going to disappear, because gold is hard to store physically. If I had 10 kilos of gold on me right now, it's hard to store that in your house safely. So therefore, I think that Bitcoin will eventually flip the market cap of gold. And we're talking about here $1 million per coin. And Bitcoin is already the best performing asset of the last decade. Based on what I'm about to show you here, it's far from done. In the meantime, you have silver, because silver is worth less than gold. And the market cap of silver is 4.9 trillion. And the current market cap of Bitcoin is 1.5 trillion. It's actually a lot less. It's 1.3 trillion as I record this video today. So this number has decreased just slightly. That means that Bitcoin needs to 3.3x to reach silver alone. So from here and the current prices, that means that Bitcoin will hit around roughly $230,000 to $250,000 as long as these market caps of silver stay the same. Which then brings us to gold. If I think Bitcoin is going to flip gold, how does it get there? Well, the market cap of gold is now currently today 35.5 trillion, and the current market cap of Bitcoin is 1.3, but we're going to use 1.5 for easy mathematics. That means that Bitcoin needs to hit 23.6x to just reach and equal the same market cap as gold, which is $1.7 million. That's still a 23x, meaning that if you just put in $1,000 and wait, you then come out with 23,000. Obviously, you may get other inflationary problems, but there we go. Obviously, gold will also increase in that time if you get those same inflationary problems. But what I'm talking about, Bitcoin flipping the market cap of gold here. And as you can see, this is the annual production comparisons of gold and Bitcoin. So as you can see, every year, so this is 1919 to 2020, 2025, we are now increasing the amount of gold being produced year upon year. But the amount of annual Bitcoins being mined has decreased faster than the Burj Khalifa, as you can see by this chart here. These are the stats here. And a market cap is just simply the total value of a coin. You just take the price of one coin and multiply it by the total number of coins. So if Bitcoin is 50,000 and there are 21 million coins, so $50,000 times 21 million, that means you get a $1 trillion market cap. And this helps you show how big something is. So the higher the market cap, the harder it is for it to grow fast. Because if something is a small market cap, let's say if you have a $10 million market cap, there is some coins that are $10 million market cap, and it hits a $100 million market cap, that's just a 10x. But for Bitcoin to go from 1 trillion to 10 trillion is a lot harder, but it's still the same 10x, but it's a lot harder to do. And this is why I think Bitcoin is nowhere near done. Because if we compare it to gold, right? Gold is seen as a store of value, so is Bitcoin. They are a hedge against inflation, as they call it. Both of them are globally accepted, and both of them have limited supply within reason. However, you can just mine more gold. So the supply is limited, but it's not that limited. Whereas Bitcoin is capped, though you cannot create more. And on top of this, Bitcoin is better than gold because it's completely anonymous. It's permissionless, meaning I don't need permission to sell it. If I had 10 kilos of gold and I wanted to sell it, I would have to go through a broker. I would have to go meet them in person or send my 10 kilos of gold through a courier service, and that's not cheap or easy. And Bitcoin is easier to store. I could literally take, I'm not going to do this, but take $10 billion and send it to somebody within half an hour. Or if I had $10 billion, put it in my pocket, I could go through an airport with that. However, I cannot travel with $10 billion worth of gold. I'm going to need some pretty big pockets for that. So that's why Bitcoin is far superior than gold. That's Bitcoin. That's tier number 1. Then we have tier number 2, the top performing layer 1. But first, what is a layer 1? A layer 1 is just a crypto that has its own blockchain. For example, Bitcoin has its own blockchain, Ethereum has its own chain, and there are many more coins with their own chain. And a blockchain is simply just a series of transactions here that end up in a sequence just like this. Obviously, these are meant to be symmetrical squares, but excuse my drawing. But as you can see now, this now looks like a blockchain. And it's where all of the data, transactions, and rules are stored and processed. They do not need any other system to work. These are the base layers. So for example, for Ethereum to work, you do not need another chain. Whereas for Aave to work, Aave is another altcoin, which we're going to cover shortly. But for Aave to work, you need to build it on top of the Ethereum chain. So layer 1s are coins that you do not need another chain for. So therefore, other tools, apps, and coins are often built on top of blockchains such as Aave. And you can see them all here. And so you can go all of the different chains. So as you go to coingecko.com, you can filter by categories and you can see all of the layer 1s here. As you can see, layer 1 is pretty much the top category. Smart contract is slightly different, but you can see all of the layer 1s here. The top ones here: ETH, BNB, Sol, Tron, ADA. Ignore Bitcoin Cash, nothing's built on that, but yeah, it's still a layer 1. And then you have all of these different layer 1s here. And each of these layer 1s has their own website where you can see all of the transactions. So if we go to SolScan, this is the blockchain data platform for Solana. If you've been in crypto for a while now, you know what this is, but you can see all of the transactions here on each of the blockchains. This is all of the transactions, and this refreshes. If I refresh this, this will be very new because this happens very, very quickly. But each different layer 1 has their own blockchain. Now, this is the key information here. The second biggest coin, i.e. layer 1, changes from cycle to cycle. This is all dependent on what people want, and that's key. Because this cycle in 2024, everyone wanted cheap and fast transactions. Last cycle, it was Ethereum, and everyone got sick of paying high gas fees, which means that you need to pay other people in the decentralized network in order to facilitate your transaction. But this cycle, it has been Solana. That's why you've seen a lot of meme coins pump, because they are all built on Solana. And this coin, this top performer in layer 1, outperforms Bitcoin for a brief period of time. When Bitcoin pumps, this pumps harder. For example, Solana did a 16x, whereas Bitcoin here did a 6.8x. And obviously that's if you catch the exact bottom and sell the exact top. So Solana outperformed Bitcoin by over 2x. However, when Bitcoin dumps, the top performing layer 1 dumps harder. And as you can see, so far in this current drop, Bitcoin has only done a 46% drop. Solana is currently down 75% down from the heights. So when the layer 1 pumps, it outperforms Bitcoin. You get a bigger pump. But when Bitcoin dumps, this layer 1 dumps harder. And as you can see, this is where I called the exact bottom of Solana. I think we head a lot higher in the long term. And this call was down here at $16 before we did that 16x on Solana here. So that was me calling the exact bottom on Solana for the top performing layer 1 of that cycle. So that's Bitcoin, tier 1, the best coin. Then you have tier 2, the top performing layer 1 below Bitcoin. The difference between the two is that Bitcoin is the safest option. We always know that Bitcoin's going to pump every single cycle. The top performing layer 1, we do know that this is going to pump, but we do not know which layer 1 is going to pump. Because if you held Solana, you would have done very well. But if you held ETH from the exact low here, you would have only got a 4x which you would have underperformed Bitcoin and you would have done better just holding Bitcoin. So this is the safest option here, but you get smaller gains. This is a more riskier option, but you get bigger gains if you get it correct. If you don't get it correct, you get smaller gains than Bitcoin. Then that leads us to tier number 3, altcoins. This is where it's even riskier, but this is where you find your largest 100x's and large multipliers. An altcoin is just essentially any coin that is alternative to Bitcoin. You could also technically class layer 1s as an altcoin, but it's just easier to categorize them as layer 1s in this instance here. Layer 1 is like your operating system, like I'm on a MacBook here, but it's like your iOS or your Android. That's like your layer 1. And then your altcoins are the different applications that you download on your phone's system. And as I said, there are thousands of altcoins being made every single day, and we want to pick the best ones. So if you want to make life-changing gains, altcoins is where it's going to be. And as I said, this is where you get a 5 to 10x, but there is minimal risk. Then as you go down this chart, this is where you get 100x, but you get more risk. And so in order to pick the right altcoins, you need to pick the right crypto narratives, because there are thousands of coins out there. There are thousands of coins getting printed every single day, and there is not enough money in the world for all of them to pump. The only cycle where all of the crypto tokens pumped simultaneously was 2017, and that was because the whole entire crypto space was tiny. This is the total market cap of all crypto coins. At the bottom of the 2017 cycle, it was worth $3 billion in total. And then at the top of the 2017 cycle, it was worth $600 billion. And Bitcoin today is worth more than nearly triple this value here. So that's why back then, every single coin was able to pump, because the system was a lot smaller. Now, the system is a lot bigger. The market is matured a lot. There are a lot more coins. Therefore, there is a lot more dilution across altcoins, and you need more money in order to pump them. However, this means that you can trade with the larger size a lot more comfortably. Back in the day, it was hard to trade with a lot of size. Now it is easy to trade with a lot of size. So therefore, it is getting harder to make a lot of money in crypto, but that's why you're watching this video, because I've done it multiple times and I've taught my students to do it multiple times. But it allows you to continually trade crypto because it is a lot more liquid asset with higher market caps, which means that you can get in and out of Bitcoin with a lot more size better now than you could back in the day. So that's why these cycles are different, and that's why you need to pick the correct crypto narratives. If you're in the incorrect crypto narratives, you're going to lose money. Exactly the same as I mentioned in the Ethereum underperforming Bitcoin just a minute ago. Now it's completely different than previous cycles because there's way more choice, and that means the money gets spread thinner across altcoins, and only a few altcoins will explode in the right narrative. So how do we pick the different crypto narratives? Here, right now, you have currently meme coins, real world assets, DeFi, gaming, and AI coins. And as you can see, these are the different ones. Obviously, you have layer 1s too. And this is how you can find the different categories. Simply go into www.coingecko.com, as I explained earlier. And these are all of the different categories here. Obviously, you're not going to pick something like made in China, real world assets, and they're the ones that I was speaking about, DeFi, memes. So each and every time you get a sector that outperforms. A few years ago, it was AI. And a few weeks ago, we had a smaller narrative on privacy tokens. But there is no real outlier at the moment because crypto is in a dip, which means it is a very good opportunity to get involved, start opening up, because when Bitcoin dips and when crypto dips, that means the developers are building for the next run. Everything here, this was a 2-year long period in here. So from all 2022 to roughly around end of 2023, so nearly 2 years, all of the building was done in this period here. But you didn't get paid the next day. You got paid a year later here. So everything that you do today in these dips will pay you in the next year or two's time. But there are still opportunities to make money in a bear market, because I was able to make over mid-6 figures trading this range here back after FTX collapsed in 2022. I was able to make 6-figure trades on Bitcoin here. I'm going to just run through with you some of the coins that I was able to pick. So FET, this was down bad. This was pulled back 50-60% before I told everyone to go and buy in this box. Before it did a 15x here. This is where I was telling everyone to buy before it did a 15 to 20x. If you sold the exact top, that's why I said 15x, because you're not going to sell the exact top every single time. You're going to scale out on the way. And I'm going to cover those, how to sell coins like this and not lose money. So I also called Pepe here. This is the bottom call. This is, if you get in on this on Pepe, it will go to all-time high. This was my buying area here before it did a 40x all the way up to here. Again, I was able to call many 1000x plays here, which helped people here, and they were able to make a lot of money. So these are just 2 examples here. So what is the next big crypto narrative? Obviously, I've mentioned old crypto narratives, but the reason why I've done that is because if I was able to predict them in the past, then that gives me a better chance of predicting them in the future, because I'm able to pivot and change my idea. So using my knowledge before, I was able to identify the crypto narratives. And what did I do? If you reverse engineer them, what does it all come down to? They all start with a big idea. Now let me go through them. DeFi, the big idea was taking over the banking system. Decentralized finance, nobody is gonna put their money in a bank again and get interest. Obviously, everyone knows interest is dying anyway, and that is true. The big idea with DeFi is that it's taking over the banking system and that your interest is better off here. Sometimes you would get over 10,000% returns in a single year holding some of these DeFi projects. Now, obviously, the edge is slowly dying and the money shifts into a new narrative, which was AI. This is going to replace all the jobs. You're never going to need to work again. Nobody's going to work in McDonald's. The burgers are going to flip themselves, etc., etc. Therefore, artificial intelligence is going to take over. All of the prices and projects in AI skyrocket because it's a big idea. Meme coins, the reason why this did so well is because fuck the VCs, it's all about the community. The big guys are dumping on us, the big banks, they pump projects, venture capitalists buy up projects early, then they dump on retail. The community just needs to hold and it will go to the moon. So these are all big ideas that people have that allow a certain crypto category to pump. So when the next layer 1 pumps, a big idea will follow. And you cannot have an alt season without a big idea and a strong narrative. You need a strong narrative in order to have a alt season now in this current market. And it's the same with stocks. Nvidia did well, so you had a bunch of AI coins doing well. And if you were investing in tech, you wouldn't have done so well. That would have worked about 10, 15 years ago, but it doesn't work so well now. So you need to stay up to date with the current big idea in crypto. And if you get stuck on one big idea, like for example, if you get stuck on the 2021 DeFi, which many people did this cycle, they didn't perform very well. So you need to stay up to date and stay relevant, because you could buy the best coin in the world, but if you buy it at the wrong time, you will lose money. That doesn't make it a scam. You just bought at the wrong time. In fact, there are some mega scams out there that you were still able to make money on. For example, I'm pretty sure if you were here in crypto back in 2020, 2021, you definitely heard about this project here, Luna. Most people had heard about this. Most people invested in it. Now, you could say it's a scam because it went to absolute zero. Sure, you can in one candle here, but it doesn't mean that you cannot make money on these coins, because look, you invest here, 2020, give or take, all the way up here, you would have had a nearly over 100x. So the price at the top was $100, the price at the bottom was 30 cents. That's over a 333x on this project. Obviously you have pump, pullback, etc., etc. But that doesn't mean that you can even buy wrong coins and still make a lot of money. You just need to buy them at the right time. If you buy them at the wrong time, here, up here in this box, I'm gonna draw a lovely little box for you. If you buy it here, you're gonna lose money. Or if you buy it here and sell it here, you made money. So it's not about how good the coin is. That helps, sure, that does help, but it's about your time. If you buy it at the wrong time, you will lose money. And that's what makes my system that I'm teaching you right now, today, so powerful, because it allows us to make crazy wins and minimize all of our losses. Now, I'm pretty sure if you've been in crypto for a while now, you have seen this chart here, the path to alt season. And alt season is where you make a bunch of gains if you didn't know already, and you can get those 100x coins. So previously it was Bitcoin, Ethereum, then all the large caps pumped, then you had alt season, because you had this flow of money, it flowed like this into here, then into here, then into here. But this chart is completely wrong. It only worked for one cycle. So the chart that I made is the same path to alt season that has worked all the way since 2013. Exactly like this. Bitcoin, number one. Bitcoin pumps. Bitcoin always pumps first. Then the money flows into the top performing layer one, exactly like my pyramid just a minute ago, like this. Boom, boom. Then the money flows from the top performing layer one into all of the coins built upon that layer one. Yes, you will still get some large caps pumping, but they will be separate. And the top performing layer one this cycle was Solana. That is because all of the volume went to this network. BNB did very well this cycle. However, Solana had more volume, therefore the Solana coins, i.e. meme coins, did a lot better on the Solana network than the BNB network. So if we sort it by volume here, instead of the numbers, as you can see, Solana has a smaller market cap than BNB, therefore there is less value in Solana, but it has nearly double the volume. Therefore, it is technically a better coin and layer one to build on than BNB. So other large caps will pump, such as BNB, etc., etc. But the main layer one is the one with the most volume. And then you will find that the alt season is the one with the most volume. And as I said before, this has worked every single cycle. 2017, Bitcoin exploded first, then Litecoin and Ripple, then some of the junk altcoins went nuts. Then there was a mega crash again. Same again in 2017, which is Bitcoin rallied, layer one lagged, and then exploded later. Then you had a massive alt season with 100x ICOs and then a huge crash. Then in the 2021 cycle, Bitcoin ran first, ETH, then Sol and AVAX followed. Sol was not as much. There wasn't as much being built on Sol as there is now. Then you had altcoin summer with DeFi or built on layer one. Then you had meme coins like Doge and Shiba exploding. Then you had the crash. And the same again for the 2024 cycle. You had BTC pump, then you had Solana pump, and then you had all of the meme coins. So this cycle of Bitcoin pumping first, layer one, then all the altcoins has played out every single time. And you can always check as well when these coins are about to go with the Bitcoin dominance chart. Because when Bitcoin dominance goes up, you just have to type in btc.d on tradingview.com to get the Bitcoin dominance chart. This chart shows the percentage of how strong Bitcoin is. For example, let's say for easy numbers, the entire crypto market cap is $10 trillion. The market cap of Bitcoin is $5 trillion. Therefore, market cap dominance of Bitcoin is exactly 50% of the entire total market cap. And obviously if it drops, then so will the percentage. And if Bitcoin climbs in comparison to the rest of the market, then it will also climb. And so this is a quick cheat sheet on this Bitcoin dominance here. When the Bitcoin dominance goes up, okay, when it rises and Bitcoin grows in percentage and the whole market is pulling back, this means that altcoins are dumping harder than Bitcoin. So when Bitcoin dominance goes up and the whole market goes down, this means that altcoins dump harder than Bitcoin. When all of the coins are pumping and the Bitcoin dominance is also going up, that means that Bitcoin is pumping the hardest. However, when Bitcoin dominance goes down and the whole market is pulling back, that means all of the coins are pulling back. This is rare because Bitcoin usually dumps harder than the rest of the coins. That means it has to, and that's very, very rare. So when the Bitcoin market cap dominance goes up, i.e. this chart here, BTC goes up, and then the whole market is pulling back, that means that the rest of the coins are dropping, ETH, Sol, etc. And all of the altcoins, that means that altcoins are dumping harder than Bitcoin. But when this Bitcoin dominance chart goes up and then the whole market is pumping, that means that Bitcoin is pumping the hardest. When Bitcoin dominance goes down, therefore when this chart goes down exactly in this period here, it usually means one or two things. If the whole market is pulling back, then it means that Bitcoin is dumping harder than the rest of the altcoins. Now, this situation is actually quite rare. And if that is the case, you would usually only get maybe like a short pullback like this before you get continuation up, or you only get a short pullback here before continuation up. So what caused this period here? When BTC is going down, the rest of the market is pumping. Altcoins are pumping harder than Bitcoin. Now, I may have like a little theory here, and I'm going to come back to this chart later in this video on how you can predict tops and bottoms with it. But I have a theory that this may continue going up if people keep printing altcoins out of thin air. So many coins are being printed every single day, and money flows in them, then out them very quickly. Then that means that Bitcoin dominance will continue to rise over time as it gets stronger in comparison to the rest of the altcoins. That's just a thesis for the future of crypto. So I've covered the path on how to get from Bitcoin pumping to the layer 1 pumping, then the money flows from Bitcoin to the layer 1 into the alt season. So what makes a good altcoin? How do you pick them? Now, there are two reasons here. You have fundamental analysis and news, i.e. trading the story. And I rarely rely on news because the news always lies, but price never does. If we go back to Bitcoin here, let's zoom in. This March 2020 crash here was the exact bottom of COVID. So when you go to the COVID crash, March 2020, this was the exact bottom, but nothing happened. There was no death toll. Nobody had died, but this marks the exact bottom of the chart. It was bad news, but it was the best time to buy here. That was the best time to buy before we had the mega rally of that cycle. Then you go back to in November 2022. Here, this also awful news. One of the biggest exchanges went down, but it marked the exact bottom before one of the biggest rallies of this cycle. So news always lies. Never trust the news. So what do we trust? Well, you can study fundamental analysis. You can study the actual project, the team, the technology, the tokenomics, partnerships, hype, and you can invest based on the real world value or potential future value of that project. However, again, you are going to be too late, because if you look at the team, are they real? Are they skilled? Have they built anything before? Tokenomics, is the supply inflation crazy? Are insiders holding the coin? Are the partnerships, anyone backing this use case? And does the project solve a real world problem? Narrative, this is the key one. Is the sector hot or not? AI, Solana, ecosystem, DeFi, etc. Are the community, does it have a big community? Are the people passionate about it, or is it dead? And is there a roadmap? Is this real updates or just promises? Now, this is really nuanced because this is textbook here. This is what you would read on any textbook on how to be the best investor. You must invest in these because they must hit a checklist, and obviously the more tick boxes, the better. But this is crypto. This is trading. This is investing. This is finance. You have a lot of retail investing into crypto, which makes it a lot more nuanced because most meme coin projects aren't doxed. Doge pumped massively, but nobody knows who the owner is. It doesn't have a use case, and it is all narrative driven, because if price starts pumping, then you get a narrative. Everyone's going to chase the pump. So therefore, all of this doesn't really matter to some extent. It's all about price. Price is the narrative. If something is pumping, somebody is going to chase it, which drives the price to pump even more. So therefore, price is the only narrative. Now, community, it does help. Roadmaps, meme coins don't have roadmaps. They're not going to build anything, but they pumped like massive. So all of these checkboxes here, this fundamental analysis, it works, but it doesn't work that much. And as I said before, news always lies, but price never does. So what do we do instead? There is one thing that never lies, and that is technical analysis. Now, a lot of people are going to go, oh, technical analysis, this is absolute bullshit. Technical analysis does work because human psychology repeats itself time and time again. But you're not just using technical analysis. You're using human psychology mixed in with a bit of fundamental analysis. But you're not looking at things so logically. You're looking at them from how other people are viewing the project emotionally. That is how you find the best crypto projects to buy. Because human psychology repeats itself time and time again. It will never stop. Greed and fear create patterns on the chart over and over again. The same patterns. And I'm not talking about a bullish triangle where it goes in here and then it breaks out and continues higher. I'm going to show you the exact trading patterns that you need to follow later on in this video, because technical analysis lets you spot these patterns and ride the narrative and ride the wave before everyone else wakes up. It teaches you how to be early, especially with my system here. And I'm going to go over a super simple explanation later on in this video. And this is where you gain an advanced edge, because you use technical analysis mixed in with fundamentals and human psychology. And with those three, it increases your probabilities of being correct in the markets by tenfold. And now you know when to buy and which coins to buy. But this is the actual strategy that will make you rich, because eventually you're going to be late to the cycle, because you do not want to be buying the top of the cycle. You could have bought Bitcoin here, up here, and then sold it down here. But you want to buy it down here and sell it up here. So how do we avoid being late to the cycle and narrative? Because eventually the cycle narrative will eventually stop. And then I'm going to tell you how to structure your portfolio, because as I said, there are 3 different types of coins. So I'm going to teach you how to structure them efficiently. So before I tell you when to sell, there is not a one size fits all with a crypto portfolio, because different people have different needs. You need to look at somebody's age. If somebody's younger, they are allowed to take more risks than somebody who is old, because somebody who is young has a lot of time. You can make mistakes and then you can learn from the mistakes as you grow as a person. Whereas if you are older, you do not have time to be making mistakes. If you're over 30, 40 years old, you do not have time to be making mistakes because you have responsibilities such as a family. So therefore, if you are young, nearer 20, under 20 years old, then that means you can take more risks. And then that means that your crypto portfolio is not somebody of the same as somebody with more responsibilities, because somebody who is younger should have less income as well as somebody who is older. Therefore, they also need to take more risks. But if you have more income, it allows you to take more risks with more capital because you have more cash flow. So as you can see, it's becoming very nuanced. And obviously, everyone has a different risk appetite. Some people don't like to risk a lot. Some people like to feel safe in their investments so they can continue to think rationally. Whereas some people can risk their whole portfolio and still remain calm. And this is okay. You just need to know your strengths and your weaknesses and play according to them. And obviously, everyone has different time frames. Some people want to play the slow game. Some people want to get rich quick, which is fine. And it is absolutely possible. Don't let anyone tell you otherwise, because anything that you want in this world, you can go and get it. So it is hard to give universal advice for everyone across every single age. So if you do want to work with me one-to-one, just check the description below and I can create a portfolio just for you and help you hit 7 figures. But this is a simple structure that everyone can follow, and it's super safe. Now, I would just tell people to have your liquid spot, okay? I would just say to most people, if you never want to do anything, obviously there's one thing I forgot here, and that is the amount of time you want to spend and how active you want to be. If you don't want to be active at all, you want to get into crypto and just ignore it. You just buy Bitcoin and hold. Buy on a dip and hold. Forget about it for years. But you're not going to get larger returns as somebody that's more active. You need to be realistic. You cannot expect to get better returns than somebody more active if you want to be less active and stay up to date with the narratives, etc., etc. But your liquid spot should just be mainly Bitcoin. And then you can switch between ETH, SOL, whichever the high cap is. And these are the coins held for months, maybe years. And you can rebalance every quarter, half a year, and you accumulate them in large dips or low volatility. And obviously, 50% is a very aggressive, and then 90% is more conservative, between 50 and 90%. Then you want to have a trading, altcoins, and rotational fund. What do I mean by this? If you want to take short-term trades, for example, 1 to 100K trading challenges with me, 1K is not a large amount of money, so therefore you can join 1 to 100K trading challenges and build this portfolio up and then rotate it back into here. And I'm going to cover that shortly. But if you're a good trader, you allocate more capital here. If you're a bad trader or new and learning, this is maybe closer to your ape fund here. So allocate less percentage here and then more percentage in your liquid spot fund while you could become a better trader and prove to yourself that you can make money in this section consistently. Then you have your ape fund. 1 to 5%. This is purely degenerate speculative plays. If you have a gambler's itch, some people have a gambler's itch that they just want to constantly feel that dopamine rush of trading, constantly clicking buttons, boom, 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 boom. Maybe not that fast. That's not good. Obviously, you're going to get smashed by fees. But just NFTs and dodgy airdrops, something like that, but ignore dodgy. We're going to protect you later on in this video again. But as it's so high risk, it should only be a tiny percentage of your portfolio. Too many people have it the other way around. They have barely any Bitcoin because they think, oh, it's too slow, I'm not going to make a lot of money. Then they have a large amount of money in here, but they're not a good trader. So they just buy, sell, become break even. Then they have one bad loss that completely wipes them. Or then they have a lot of money in their ape fund because they think they're going to become a top gambler and it absolutely wrecks them. But this is my critical rule here, okay? The flow of funds should only go one way. You should only make money here and put it into your trading fund or your liquid spot fund this way around. You should never do this. And I'm saying never take money from your liquid spot fund, you can maybe put a small amount in there, but do not keep topping it up. Never go backwards. Never put money from your liquid spot fund into your ape fund. This is a big no, because if you make money in risky assets, you put the money in safer assets. That is the only way to do it. This prevents you from doing stupid, reckless gambling with your core safe holdings. Only go this way. Do not go backwards. But this is one key here. You need a cash category. And a lot of crypto traders neglect this because they think, I must be invested in the market 24/7. But you need to keep some money in cash for two reasons. If you're a full-time crypto trader, cover real-world expenses. Also, if you have money in cash, you are able to take opportunities of dips. You are able to buy dips. If you buy here, sell here, buy here again, and then sell here, you're going to make a lot more money than buying here, holding through this pullback, holding here, because you're then conditioned to hold, and then you pull back, okay? And then you basically may as well just bought here and sold here. So what you do is, for example, if you buy here, you trim some off on the way up. Then when price pulls back, you can use the money that you trimmed off back here. You will not sell the top precisely every time, but you can trim it off up the way. Now, let's say you're 90% crypto here. Then you want to be 50% crypto, 50% cash here. So that means you have 50% cash to buy this dip and ride it up again. So now you're back into 90% crypto, 10% cash, then here 50-50. Because then that means only 50% of your crypto goes down and you still have 50% cash. You can play around with these numbers. I'm not saying that they have to be the same. I'm just using that as an example. But again, then you are able to buy this bottom then. Let's say if this is the bottom and we go up to here, and then you are able to make money with the cash that you have just made. Therefore, your cash pot always increases no matter the dip. So always have some cash. So how do we buy and sell at the right time? Obviously, buy low, sell high, obviously. But how do we do this? Simply, you just do it exactly with the system I just explained there. Buying pullbacks, it's that simple. Most beginners just want to buy when it's green. But I do the exact opposite. I wait for all of the hype to die down, and then I buy after price has already pulled back. This is when people are scared, not feeling excited, feeling comfortable. If it feels boring or uncomfortable to buy, this is usually when the best entries are. You just listen to your emotional needs and your wants and then just do the opposite. For example, let's say if price has absolutely capitulated, it's dumped so hard, your 50% of the crypto here, you see it's dropped 50%. So you're going, oh, you still get those feelings, but then you still have 50% cash to take advantage of those opportunities. That's how you would do it by buying pullbacks. That's how you buy low. Just simply wait. And this is how you sell high and avoid buying high. Just avoid FOMO. If everyone on Twitter is buying it, just do not copy the crowd. Most people just scroll through Twitter looking for advice. Which coin's good? Somebody's going to talk about it. Which coin's good? Oh, this guy's talking about it. Wow, that's amazing. But if somebody's talking about it on Twitter, you're usually too late. When people are talking about it the least, that's when the best opportunities are. Because obviously, not everyone wanted to buy crypto down here. Everyone wanted to buy crypto here. Nobody wanted to buy crypto here. Everyone wanted to buy crypto here. Now nobody wants to buy crypto again. Isn't it funny that way, that the best opportunities come along when nobody wants to buy them? So if people are getting FOMO and everyone wants to buy crypto up here, It's that feeling when price is going up fast and you get that feeling, if I do not buy now, I will miss the pump. So then you buy the pump and then the pump stops pumping and it continues to crash. And then you just don't buy the pump. You buy the crash or pullback. It's a nicer way of saying it, pullback. That's how you avoid FOMO. And so there is an exact pattern that I follow that has allowed me to call bear markets at the exact top. How I was able to call this top here on Bitcoin. And this is May 2021 here. This is me calling this bottom here before this pump. This is the price action here. Then this is my verified calling the top of the bull run in November 2021. I've posted a bunch of bullish charts. However, after this BTC pump, I've taken more profits on positions. I will look to read on everything after a liquidation cascade. And we have not had a liquidation cascade since September. And it's been easy to make money for 2.5 months, obviously since May. So this is me saying it in November the 2nd, 2021, October, November. Here, I have sold a lot more of my positions before a liquid cascade. And then I put a post out saying that I will relong Bitcoin back at 30K down here. And obviously I waited, changed my mind as price went down, and then I ended up buying here. And then this is me longing the bottom of the bear market in November 2021, as I've already discussed. And this Telegram here, where I posted this, is in the description below as well. And how can you do the same? How can we do this for the future? And again, if you've been in crypto for a while now, you've probably seen this chart, but you need to etch it into your brain, because when people feel this emotion here, euphoria, they forget this chart. They think that this euphoria here is down here. Hope. I'm still feeling hopeful. But you don't understand that somebody else has bought it down here. Now, this chart is all about emotions here. So it is good, but it's not a system. You cannot systemize this. This is about feelings, and your feelings towards the market can change depending on where you've bought. If you've bought it here, you're feeling hopeful because you're feeling hopeful that your investment is going up, but it's not. You've bought euphoria, so you are hopeful. You think it's here, but it's actually here, or complacency. So this is the true chart here. These are the 4 stages of the market cycle in a systemized format. So we have stage 1, accumulation. This is the best time for buying, or just as we break out of an accumulation into an uptrend. Don't worry, I'm going to go through each of these steps very clearly in just a minute. But as we break out of the accumulation, this is the best time for buying because you do not have to wait through the accumulation period. Then you have the bull market, an uptrend, aka higher highs and higher lows. End of stage 3, distribution, and the beginning of stage 4 is the best time to sell. I'm going to teach you the signals that you need to look for in order to sell and buy at the right time as well, at the top of the crypto market and the bottom of the crypto market. Then after the downtrend, aka the bear market, we go back into stage 5 and stage 1. They're both the same, and we go back into a reaccumulation. So price always starts with accumulation. The reason being is because the market consolidates in this period here. And one thing I like to say here is consolidation leads to expansion. The longer a market is consolidated, the larger the expansion, which means that you will have a large bull market or a large bear market, depending on how long we have accumulated or distributed for. Obviously, you can go vice versa. But every single time, a market cycle will always start with accumulation. There is zero doubt about this. You have to have this in order for price to pump, because it means that price has gone sideways for a long period of time. This is your highs and this is your lows. Price after a bear market usually comes down. We find the lows here. Then we establish the lows and then the highs. And then this is where we start the accumulation range before. But in this area, prices are low. Sentiment is dead and everyone says it's all over. You'll see a bunch of KOLs disappear off the market completely. If you're still in this phase during this accumulation period, you are one of the smarter people, because a lot of people leave in this period and then come back at the top. Whereas if you're in this accumulation period, this is the time to make money because there's no hype, no influencers, and very little retail. But this is where the millionaires are made, because nobody wants to buy and it's boring and it's scary. So that's stage number 1, accumulation. And how does it look on the actual chart? As you can see here, we've come from a bull market into a bear market. Then we established a high and a low in this period here. There we go. So as you can see, this period here is the accumulation. We have spent a lot of time between a defined high and a defined low here. Therefore, we have accumulated, aka accumulation, in this range for over nearly 2 years in this area. So therefore, this is a large accumulation period. Then once price breaks out of this accumulation, we move into stage number 2, the markup, aka the bull run. And this is the best time for buying here, just as price breaks out. Obviously, you're going to get a better multiplier down here in the accumulation range, but obviously it is a lot riskier. And in this period, the bull run, price starts to climb and early believers need to double down. Influencers start to return. You start to see some hype and momentum grows. You'll also see conflicting opinions in this area of some people being bearish and some people being bullish. Obviously, there are a lot of people in crypto now, so the conflicting opinion is going to get heightened at the top also, but it usually is about 50-50. And if you see that shift start to go from 60-40, 60-40, you know, that's what I'm trying to say here. Hype is starting to build on the pot of 60. Media starts to report bullishly. Retail starts to return, but it still feels very early. And this is where you want to scale in hard into your positions. This is the period here. I need to emphasize this the most because this period here is when you need to apply the most amount of risk. A lot of people don't like to do this because you're coming off the back of a bear market and people are not trained to hold their positions. For example, here, if you held your positions, you'd be down bad. Also, if you held your positions, you'd be down bad. If you held your positions here, you'd still be up, but you would have to wait at least 6 months. So you are trained to not hold your positions for a long period of time. Therefore, as you enter stage 2, you need to switch your bias. As price breaks out, it starts to make higher highs and higher lows. You need to train your brain in order to hold your positions longer. There's your higher high, higher low, higher low, higher high, higher low, higher high. I've gone backwards. And as you can see, this bull market pattern here uses a very simple support and resistance setup. Resistance to support. Resistance turns to support. And that is very, very simple in that way. And that's stage 2, the bull run. You need to be aggressive early on because that's where you are going to make the most amount of money in this space. And let's look at it on the chart here. As you can see, we start to break out. We then retest this accumulation range here, and then we start making higher highs, higher lows, higher highs, higher lows, and so on and so forth until obviously higher high, higher low, higher high, higher low. And as you can see here, we make very, very clean SR levels. Resistance turns to support, and then the same again here. Resistance, if I break this down on a daily time frame, there will be support and resistance. So as you can see, in a bull run, we have now broken out of a long accumulation into a bull run period here, phase number 2, which then brings us into stage number 3, distribution. This is when prices are at all-time highs and everyone's a genius. Everyone's making a lot of money. It feels safe to invest in crypto. This system here works across any market, but it particularly works the best in crypto because the investors and traders are extremely emotional to their holdings. Therefore, this whole systemized market cycle works extremely well. Everyone thinks they're a genius, but smart money, the people that bought in stage 1 down here are now quietly selling their bags up in this period here because they invested small amounts of money in this stage 1 period. Therefore, their bags have grew into a large amount of money. Therefore, they are now able to sell their positions into the market highs because there is a lot of volume now in this stage 3 because a lot of retail have returned to the market. Therefore, the volume has increased. Therefore, you can get a lot more position size out into the markets. Volatility has increased in comparison to the previously. As you can see on the chart here, this accumulation period seems very, very small now. The news is extremely bullish, and this is where most people FOMO. As per what I said earlier, this is not the time to FOMO. This is the time to exit or short if you are skilled, not to enter the markets. And this is exactly where I called the previous top of the bull run in 2021 that led to the bear market, as per my example earlier. And this also is usually in the form of a consolidation, but this consolidation is not as long as the accumulation period. It's usually a very short period in time. As you can see, this is your highs up here. You could even say this is your highs and this pump here is a fake out, and then here is your lows. You could also be more refined here with there's your highs, there's your lows, and as you can see, this period here, you established a high, established a low, and now we are in a range. We poked out to the highs, we poked to the lows, we failed to make another high, we broke down, we retested, and then we entered stage number 4, aka the bear market. This here is the best time for selling with the lowest amount of risk, because you could say you could be in the market here and this could very well go higher. But once we break down here, this is your best opportunity of selling. Once price breaks down with protecting capital. Obviously, you're going to make money if you sell up here. However, if you want to also hedge your bets and make money to the upside, you can also sell here. Let's say if you forget to sell your positions or you failed to sell this exact top here, here, and here, the market gives you another opportunity to sell your positions here before price rolls over and you capitulate and lose a lot of money. Because in reality, selling here is exactly the same price as selling here, but selling here is a lot worse than selling here. So this is also a good time to sell before we head into stage number 4, the downtrend, aka the bear market. This is where reality starts to set in and price starts to drop fast. We start making lower highs and lower lows in the market. As you can see, there's a high, there's a lower low, there's a lower high, there's a lower low, and there's another lower high. And this is when retail is left holding their bags, and then they start to panic, and so they start to sell, which then causes more sell pressure and pushes price further to the downside, and your losses start to compound, and then more and more people leave the space. Eventually, there are no more people to sell, or very few people to sell, because it's down quite a lot, and therefore we find a bottom, and then we are back to accumulation. So what does this downtrend look like on the chart? Well, as you can see, we had our stage 1, our stage 2, our bull market, stage 3, distribution, and once we broke down, we then come into a bear market where we start to make lower highs, lower lows, lower highs, lower lows. In this instance, we made a higher low, but we still continue to make lower highs, and then we made another low back into this area here before we broke down, made another low, and then we repeated this whole cycle again. As you can see now, there is the bear market. And what you will find is there will be some overlaps in the market conditions, because that is what confuses people. That's where the confusion starts, because really you could say the lower lows were created here very early on in this range. But because that lower low was created, you are given signals and telling you that the market condition is about to shift. And that is really where 99% of people make mistakes in the market. They identify the market condition incorrectly, and then they apply the wrong strategy to that market condition. For example, accumulation here, everyone's too afraid to buy, or they are not patient enough to wait out the accumulation range. So then therefore, they are forced to chase in the uptrend here. And because they are forced to chase in the uptrend here, then that means they don't make as much money as they thought they should. So what happens is that they saw price down here, they then think they should have a certain amount of money, but then they buy here, and then now we're in distribution here. They then convince themselves that this is another reaccumulation like this before market goes higher. Then what happens is they continue to hold their positions, but price breaks down, and now they're back at break even again. They've held their positions for all this time, and they're back at break even. And so then they're now at a loss, but then their loss is so bad, they may as well hold their position or just sell it for scrap. So that is why a lot of people apply the wrong strategy to the wrong part of the market cycle. And that's why it's super, super key that you identify which phase of the market cycle we are in and apply the correct strategies in order to make a lot of money. And in order to identify the top alongside the market cycles, so you get the best possible result. Once you understand the market cycles, in order to get the best possible result, we stack reasons on top of each other to get the best situation and give us the highest probabilities of us being correct. For example, how was I able to spot the start of a bull market? Because everyone wants to time the bottom. But the truth is you do not need to be perfect. You just need to get close. Here are some of the reasons how I did it. Number 1, everyone is gone and nobody cares anymore. Crypto Twitter is dead. Influencers stop posting, or they start to change into other sectors like Forex. They start Forex trading, or they start trading stocks, they start trading gold. Maybe they start posting about gambling, which we're seeing currently. And then obviously, as a result, all of the group chats are silent. And this is when I start looking hard for opportunities. And obviously, Bitcoin is also down 50 to 80% from the top. I've adjusted 70 to 50 because sometimes 50 is enough, depending on where the prices are. And typically that is where the best entries are, and that's where the max pain is. And then we chop sideways for months as well. Nothing is happening, which is accumulation. And this is when, as I said, in the previous market cycle, smart money is buying. And this is when the risk assets come back to life, and Bitcoin always moves first. So as you can see here, this was all of those. This was, everyone had gone. Bitcoin was down 70, 80% from the highs, and then we chopped sideways for months. And on top of that, what happens is the rate of selling slowly eases off. As you can see, these two lines are very aggressive, and then this line is not as aggressive here. So usually you would get a petered off bottom like this, and then that's when you form the range in this area here before then going to brand new highs, obviously. And also, to add on to this, Bitcoin then starts to break the major high. As you can see in this range here, let's straighten out those lines, but we broke a major high, and then we started to retest this consolidation as resistance turns back to support here. So we broke the major high there before we went on a big rally. And if you do want to wait for confirmation and you don't want to buy the exact bottom, you are going to buy at a higher price. For example, if you wait for here at 25, 30K, you are going to pay a higher price. And then if you were paying for Bitcoin down here at 16K, but it is obviously with more risk. So you can need to pick your style here, whether you want to have more confirmation and it be safer, or you can time the bottom better down here with a little bit more risk. And there are several ways to do this. Accept the truth first. You might not catch the exact bottom. You might not catch 16.5K like I did. You may end up paying a little bit higher, but that doesn't really matter. You just need to be in the bottom zone. And if you are buying spot and you aim to accumulate coins like Bitcoin, or if you're not a skilled trader, you need to use something called dollar cost averaging. Really, we're in that bottom range here. Make sure you are in a bottom range. Don't average down into a downtrend. Make sure, which most people do, make sure we have bottomed and we are in the range first. This is when you can start to average in this range. For example, let's say if you want to invest $5,000 into Bitcoin, you can spread it over a few weeks, a few months, depending on the time frame. You can buy $1,000 here, $1,000, $1,000, $1,000, and then if it drops again, another $1,000, and so on and so on. And this way you safely average in and avoid buying all here. Let's say if you buy here at the top before it dips, now you're underwater on your position before it ends up going higher. Because you bought here, you may be emotional, and then you may sell here before price then goes a lot higher. Obviously, this is very messy now. But what I'm saying is, if you're in a range, instead of maybe trying to time the breakout by buying it all there and then becoming emotional if it does a dip like this, so then you force to sell, because obviously you still need to manage risk. You buy a bit here, 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 and then you buy the rest here. Therefore, you probably have an average entry around here, and therefore it's not as bad to stomach as this bit here. But what you do not want to do is take this advice and then start to average in a downtrend. Let's say if price is doing this, you start averaging in like this. This is not what I'm saying. I'm saying once price is bottomed, we are in the accumulation range. This is when you want to start doing your dollar cost averaging. Or step number 3, wait for the confirmation. Once we have started to break out of this range, like up here, this is when you want to start buying. If we come back down and continue, then hold your position. But if we come back down, back inside this range and hold, then you can scale out your position there, and it's a lot safer. And as I said, you may pay a higher price, but at least you know you are protecting your capital. So that's how to spot the beginning of a bull market. These are the signs that we need to use and stack on top of each other to spot the end of a bull market. And so how do you call the top of the bull run? We may not know the exact top, as I said, we may not call the exact bottom, but as long as you buy roughly near the bottom and then you sell roughly near the top, that's a very, very good trade, and you're going to make a lot of money in the long run. So as I said, there's a lot of retail of euphoria. Your Uber driver is shilling you coins. Maybe a lot of people talk about crypto now in general. A lot of people have crypto. However, if they start shilling you a certain narrative, as I spoke about earlier, for example, if they start to talk about meme coins a lot, then that narrative is starting to get a bit what I call frothy and a bit euphoric before prices drop. Obviously, influencers also drop pay promos. This is just exit liquid strategy. Okay, so start to get cautious. Then you also have a crazy altcoin mania. A lot of people nowadays say, oh, well, we're still waiting for alt season. We're still waiting for alt season. We're still waiting for alt season. And this is not what we're looking for. We're not looking for alt season. We are looking for a certain narrative that is going absolutely crazy and maybe in accordance with the Bitcoin dominance. Because every time the Bitcoin dominance is here at the lows, then that means, look, this was the January 2018 top before Bitcoin fell from $20,000 all the way under $3,000. Then we found a bottom in March 2020 here before the start of the next bull run. Then the bull run happened. Then we had DeFi summer all the way down here in 2021. Then you had the top in May 2021 here. We then traded in this range. Then the top of the market was December 2021 before we pumped up here. So obviously ever since here, Bitcoin dominance has been pumping, but historically bottoms have been caused when Bitcoin dominance pumps and tops have been formed when Bitcoin dominance is extremely low. Now this cycle is a little bit different because we have just slowly grinded up because Bitcoin has increased its market cap exposure in comparison to the altcoins because some of the altcoins have bled off. So this may change in the future depending on what the narrative is. And step number 3, Bitcoin also slows down. What happens here is Bitcoin pumps and then it starts to go sideways. For example, here, Bitcoin pumped like massive. And then we went sideways in this period here from November 2024 to December 2024. And in this box here was when we saw all of the Solana meme coins pumping. So as you can see, December 2024, you can also see here all the way from August, September, October, November, December in 2024 as well. This was also when Bitcoin was starting to go sideways, Popcat started to pump. So once Bitcoin slows down and then you see some of the other altcoin narratives start to pump, that's when you want to be cautious. And these are just some signs that you want to look for to the top of the cycle. And obviously, this is the number one thing that people say is when the Coinbase app or obviously the Robinhood one now, start to creep up on the top apps on the App Store. Once they start to creep up to the top, say 1, 2, 3, trading, investing, Webull here, that is when you want to start to be a bit cautious because a lot of people are trying to get into the market. And how do we sell the exact top? Because people always miss. They always go, oh, it's so hard to sell the top. And it's not. It's because a lot of people get greedy. So what you do to prevent this is set your targets in advance. Know what rough percentage gains you are about to make from this coin when you enter with a logical mind. So if this hits 5x, I'm selling 50% here. And then if it hits 10x, I'm out of this position. For example, if you buy a coin here, you have maybe take some off at 2x, maybe say takes another off at 10x. So as it pumps, take some off here, then take all out here. And even if it keeps going, it doesn't matter. Because if you do not set your own targets, you're not going to sell. If you don't set these targets, what you're going to do is you plan to buy here. It pumps, it's 5x. You go, maybe I hold it all for 10x. So you hold it all for 10x and maybe I hold this for 20x. Maybe I can make even more money out of this. So you don't sell a single penny. And then what happens is it reverses about 50, 70% in a day and you get a big liquidation cascade. Then you go, I'm not going to sell this now because I had an XYZ amount of money up here and I could have bought XYZ with that amount of money. Therefore, I'm not going to sell and I'm going to hold this position because it's going to bounce and then I'm going to sell on the bounce. So it then starts to bounce and then you go, maybe it's going to overtake and get back to the previous high. And then it doesn't. We make a complacency shoulder hit. And then it falls back down. And then you just give back even more money and then you sell for an even more loss down here. So how do you prevent this? Set your targets in advance or you sell in stages. You dollar cost average out. Exactly the same as the way you dollar cost average into a position, you dollar cost average out. Let's say if price starts to pump, you are trading a very small coin with a very small market cap, about 50 to 100 million. You want to scale out your position, sell 1, 2%, sell a percentage, sell a percentage, sell a percentage. As long as your average entry is under here, that doesn't matter. I know you don't want to buy in a downtrend, but you can sell in an uptrend and lock in some of your profits here. So maybe sell 25% after a big pump, then sell to another 25% if it doubles again, and leave a small moon bag if you are feeling greedy. So they're just 2 ways of selling the top. And obviously step number 3 is being very good and highly skilled, similar to myself. That's how I was able to call tops, where you're able to just sell all of your position up in this period here. But if you do not have those skills yet, or you want to do it by yourself, then that's absolutely fine. I've given you 2 ways to do it. And typically, this is not a hard, this is not entirely true. But if you also want to time tops and bottoms, you can also look at other markets. For example, Bitcoin follows the stock market SPX 500 because when stocks goes up, Bitcoin also usually goes up, give or take. And then when stocks crash, Bitcoin always usually crashes too. So as you can see here, I have now overlaid SPX 500, which is the blue line here, on top of Bitcoin USD chart here. And as you can see, this was the top in 2021 and SPX 500 started to trend down. This was the bottom in November 2022, roughly. This was the bottom, and therefore we found the trend following its pattern here. Sometimes in this moment here, you get small dips on Bitcoin, but you don't get them on SPX. Here, you got a small dip on Bitcoin and you roughly match the same percentage as the dip on SPX. At the moment, Bitcoin has dumped and it hasn't dumped. So you can use it as a rough guide to kind of gauge where Bitcoin is going. This has only really happened in this period here. As you can see, March 2020, you got the big crash on both of them. And ever since then, they have followed each other very, very similarly. So Bitcoin follows the SPX 500. Bitcoin also moves opposite to the US dollar. And the ticker for this is DXY. When the dollar goes up, Bitcoin usually goes down. When the dollar goes down, Bitcoin usually goes up because Bitcoin is a risk asset. When people buy it, when they start to feel confident, and they sell it when they're scared, obviously. Now, again, this is not going to follow each other directly. And in fact, these are going to follow each other less than the S&P 500 because dollar is relatively stable. Bitcoin is not stable. But as you can see here, this was the top here and also here technically. But we also found a bottom here on dollar before price started trending up in a parabolic advance. So that was the bottom. This was the top on Bitcoin. This was the bottom on dollar. Bitcoin then trended down and found while dollar trended up. So they are inversed. Then when Bitcoin found a bottom down here, this is when dollar also topped. So as you can see, dollar trended down, Bitcoin started to trend up. Obviously, in this period here, we did follow it identically, but you can kind of see how Bitcoin does follow the trend of the US dollar. So I'm not saying go minute by minute. What I'm saying is use the weekly and the monthly timeframes to gauge the direction of the trend in order for you to be able to call the tops and bottoms of the crypto market. That is the best possible strategy to use this for. But before you buy any of these coins, people always ask, how much money should you start with? And there's something that I like to say here. In fact, it is actually better if you start with a smaller amount of capital, because the amount of times I see somebody brand new to the market who thinks they can do it by themselves put too much money in. And that's the key there. If you think you can do it by yourself as a complete beginner, you will always lose it. Now, the caveat here is if you join at the beginning of a bull market, you will do very well. I'm not going to say you're not, because all you know is how to long. The market has trained you on just longing. And so you will make a lot of money. But what will happen is that you will, number one, you will fail to adapt to the market conditions. For example, a simple crash like that could take you out because your risk appetite is too high. So you failed to adapt to the market conditions in this period here. Or number two, the numbers actually get so big too quickly that you cannot keep up with it and it starts getting to your head. So let's say if you make 5 million starting with just a few $1,000s, then you continue that same level of risk as you started with $2,000 and continue it with $5 million. You will lose the $5 million very, very quickly. So if you lack the experience, start with a small amount of capital. This is exactly what I did. I went from here, working a 9 to 5, and I started with just $2,000 in my name. And again, for the second time, after I had $5 million stolen from me in the FTX collapse, I started again with just 3,000 euros. You do not need a lot of money to start in crypto. And as you can see here, the first time round, I was able to buy my car. And the second time round, I bought my second car here, which is a brand new Aston Martin. And also for other people, Clement here, he joined my 1 to 100k trading challenge and he turned $500 into $4,000 in less than a single month. And Kaizen here, he started the 1 to 100K trading challenge, and then he completed it within 3 to 4 months. As you can see, his 100K balance here. And then he stayed in the group, and he was then able to make 7 figures. Jigsaw here bought a Patek Philippe with his profits, and he was in my inner circle for a single month, and he generated over $50,000 in profits in his first month. So if you want to join my 1 to 100K trading challenges, check the description below. It's all in there. So, and you're probably wondering now, how do you grow a small account just like the students I've just shown you and myself and produce results just like this? So if you want to grow your account very quickly this bull run, you need to hold less coins, because a lot of beginners think you must hold a lot of coins, and you probably didn't buy half of them with a plan. You just bought them because somebody on Twitter, you saw a call on Twitter and somebody told you to, which means you bought when the price is already high because they're already talking about it on Twitter. Everyone already knows about the coin. And then when the price dips, you are forced to sell at a loss, or you hold it all the way to zero. And so what do I mean by this? Let's say, for example, half of the coins win and half of the coins lose, which is a very realistic thing in today's market with only a certain amount of crypto narratives popping. So let's say, for example, this here, coin 2x's, 2, 2. These 3 coins here, 2x. You've made a cracking call. But these 3 coins drop 50%, 50%, 50%, okay? At the end of this, you've come out break even. You've done all of that work, but you've ended up with a break-even portfolio. It could be worse, because as I said, only 1 or 2 narratives pop off. And let's say you try to diversify your portfolio, as they say, into many different coins. So you buy it in different categories. And in fact, only 2 coins do well and do 2x. Now you are losing money in this current market. And those are easy numbers. Obviously, one can do a lot better. One can go to complete zero. And then those numbers are a bit skewed and it's harder to track. So therefore, buying more coins does not mean that you will get more profits. In fact, it's the opposite. And you are not diversifying your portfolio, spreading it across different coins. You would diversify your portfolio better if you went into the stock market or another form of a lower risk asset, because crypto is a high risk asset. But with high risk, you get high reward, and high risk, obviously, you can get higher losses if you do not manage your risk correctly. If you manage your risk correctly, then you'll make a lot of money. It's simple as that. If you can manage your risk in crypto, you will make a lot of money by default because you have protected yourself from the downside losses. So what you need to do here is reduce the amount of coins. So we are not looking to spread our risk. In order to gain money in crypto, you need to concentrate your risk. And I like to say, focus on one area. Because other people, like Warren Buffett here, he put 40% of his portfolio into an American Express in the 1960s. This was a high conviction bet from him, and this helped make him become one of the greatest investors of all time. And every single crypto millionaire that I know didn't buy 100 tokens to get rich. They went all in on one narrative. And this is the same for myself. I didn't invest in tons and tons of different tokens. So what that means is conviction matters more than diversification, because what you do when you diversify your portfolio is already massive and you're sitting on a large portfolio and you want to protect your capital. When you have 7 figures, that's a large portfolio. Maybe it's a small portfolio for some people. There are crypto traders out there with 8, 9 figures. So sometimes 7 figures is small. But what I'm saying here is when you have 7 figures, you can make 10 to 30% a year and live off of that. You do not need to take excessive risk. That's why you diversify then and only then, and there's a way to do it. For example, let's say if you make $5 million, right, and you live off 10 to 30% a year, you've made between $500,000 and $1.5 million just on 10 to 30% alone. But if you are trying to grow a portfolio, which is probably why you're in crypto, then conviction in a few areas is what is going to scale it. And I'm going to show you the exact strategies on how you can scale a portfolio shortly. But what you need to do first is cut down on the amount of altcoins that you're holding until you see a golden opportunity, and then you go all in. One of the examples here, back in the old 2020 bull run, was Room. I bought this at around here at 20 cents before it ran up all the way to $18. Then in this current crypto market cycle, Pepe, as I shown you as per the example earlier, I was buying it down here at 0.0000064, and then it went up all the way up 40x into this area. I invested in about 6 figures in this area, and that made me a good 7 figures. So as I said, there are 2 ways to grow a small crypto account. There are a few more, and they take a lot of time, but for this crypto course right here, these are the 2 strategies that you need to follow. Because let's get this straight. You are aggressively flipping a small crypto account to get filthy rich. This is not a long-term safe strategy. If you want a long-term safe strategy, you need to play things very differently, and you're playing the long game, which usually means that you already have a fair size of capital. But the best way to make a lot of money is to start very small and aggressively risk that money in the crypto markets until it becomes a large portfolio. Then once it's a large portfolio, you decrease that risk. So I'm going to go through how to do that just now. One of these strategies is passive. You just wait and then you go for that perfect home run. The other is active, and then you go for wins smaller, but those wins are more frequent, like every week, every month. You compound that account. So first of all, let's cover the passive way. You're looking at coins that do 100 to 1000x, and they still are possible in today's age. However, there are less coins that are doing it, and most coins never do those kind of returns. And the ones that do usually take weeks or months to play out. This is why this method takes less time overall, because you're not doing active buying and selling. You're just watching and waiting for that golden setup. And the key here is waiting. And there are a few times a year when the market gives you golden opportunities where one coin can multiply your money very, very quickly. And that's when you need to be locked in during this period when the coin is pumping, because coins don't pump all of the time. For example, we go to the chart here on Bitcoin, and yes, this chart is going up. Look, over 1,000 days, but when the pumps actually happen, they're over very short periods of time. This one is 150 days. Then you went sideways for 245 days. Then we pumped for about 35 days, and then we went sideways and down again. Then we pumped for about 100 days. So the pumps do not last that long. So you need to sit and wait and then lock in when you spot the coin and the opportunity, and you buy it early, and then you wait for it to hit that home run as per the market cycle and all of the factors of confluence that I mentioned earlier. And I'm going to cover the 100x trading setup at the end of this discussion here about this passive investing, because there is one trading setup that allows you to make a lot of money very quickly. So if you want to make 100x, you need to assess where the highest probabilities of you making that 100x is, because every single coin has a market cap. Now, if you're buying a coin at 1 mil market cap level, I would typically avoid these because there are a lot of rug pulls and they are insanely volatile. For example, you buy a coin at 800k market cap, very, very small, and the odds of an 800k market cap going to very high is very, very slim. But at an 800k market cap here, let's say price drops 50% to 400k. That's very possible. It's dropped 50%. Then it pumps to 1.2. So it's gone from 400k to 1.2. That's a 3x and nearly a 2x from your initial 800k. Then it comes back down. So as you can see, your portfolio is halving and doubling very often in this market cap region. So that's why there's going to be huge volatility here. But if you do have an edge in this area, then obviously you're going to make a lot of money. But this here is the best area for a 100x. 1 mil to 10 mil market cap. If you find a coin in this area that is on narrative and it is a good coin in the 1 to 10 mil market cap region, the key here is on narrative, because if it's not on narrative, it's not going to pump. Then this is the best area for a 100x. But there is still large volatility. It can go from 3 mil market cap down to 1 mil, which is a 66% drop. Then it can go from 1 mil to 8 mil, which is an 8x. So it's still insanely volatile. And this area here is where you look for the best setup, which I'm going to explain shortly. What you want to see is this project in this area here of 1 to 10 mil start to build, and very few people talking about it. But this is the best area here for it to 100x, because at 1 mil market cap, it goes to 100 mil. You've already made your 100x. At 10 mil, it goes to 1 billion. Obviously, you've also made around 100x. This is where you get 1,000 in, 100 100,000 out. And these are your highest areas of probability for 100x. Now, at a 10 to 100 mil market cap, you may only get a 25 to 50x, but it is a lot safer because between 10 to 100 mil market cap, there should be a lot more volume and you are able then to get more money in than in this area here, which means that you can get a lot more money in and it be a lot safer. For example, let's say if you only put $1,000 here and 100x's, you have $100,000. But you put $10,000 in at 10 mil to 100 mil and at 25x's, you have made 250k. So it depends on the amount of money you put in and the multiplier you get. That is all that matters. And in this 10 to 100 mil market cap, you want to put more focus on price action because there will be levels, there will be tradable levels on the chart, support and resistance levels that buyers and sellers will look to buy and sell. And so therefore, they will not just trade through them and you can trade off them actively as well, where you can find entries on the chart. Then you also want to buy pullbacks. Let's say if it pumps to 25 mil and then pulls back down to 10 mil, this is where you want to look to buy if you are bullish. You want to buy pullbacks if you're still bullish. And you want to look for coins that are going to be leaders of the narrative because they will then eventually go on to become 100 mil to $1 billion coins. But if you're looking at coins in this area, 100 million to 1 billion, focus on strategy number 2, which I'm going to tell you shortly. But this is where price action is more established because these coins are usually on tier 1, tier 2 exchanges that you can actively trade and will have the liquidity for you to do so, meaning that you can buy and sell a lot easier through an exchange. And you're going to be actively trading price action in the 100 million to 1 billion plus region. As I said, they're typically on exchanges. However, you will probably not find 100x. You may get a 5x, you may get a 2x, but that's when I'm going to focus on strategy number 2. So if you want 100x, this is your highest probability for them here. In this between 1 to 10 mil is the best. You may find smaller returns in the 10 to 100 mil. As I said, I still made 7 figures out of buying Pepe at a lower market cap and it did a 40x. So, you know, it just depends on how much money you put in and you get out. And that is the passive way to do this. The other is more active. And this is where you just need consistent 2x plays. And what you're aiming for here is very simple. You're just catching doubles. Because how many times have you seen a coin do a 2x? It happens all of the time. Because recently, I called many 2x's. Solana, Aave, Bonk, Popcat, Hype, all did 2x recently. But most people mess it up for 2 reasons. For number 1, they sell too early. Price hits a 2x, they think it's great profit, so they sell. However, they then watch the coin run 10 to 50x without them. Then they get emotional, then they start to FOMO back in at the top here, and then they just give back all of the profits they just made. It just needs to dip 50% for you to lose all of your profits. So that's where most people mess a coin like this up. They do a very good trade, but it keeps running on without them. They did a very good trade. They maybe have sold it too early because maybe they're underwater on the rest of their portfolio. So they're just coming back to break even, then they sell, but then it keeps pumping. Then they buy in with more at the top here because they think they found the biggest winner of all time, but it has already done a 10 to 50x, which is huge. Then it comes all the way back down and then they basically round trip all of their profits. So how do you prevent that? How do you prevent from selling too early? Well, you have to assess your situation. And if you are looking to just hit consistent 2x's, then this is going to happen a lot. You're going to buy a coin, sell it for 2x, or maybe even 50% gain. Doesn't really matter. You made a large move and then it goes off without you. Doesn't matter. You lock in your profits, move on and look for the next coin. It doesn't even matter because your strategy is very different than what this coin is doing. Do not get sucked into it. So, or number 2, because their last play did hit a 10x and they sold at 2x and then it runs to 10x, then they find another coin, a brand new coin. Then they buy, it does a 2x, but then they think they've caught another big one. They think it's going to run another 10x, but it doesn't. They don't sell. They think it's going to continue going higher. They don't sell. So then they end up round tripping everything that they've just earned. So that's what prevents most people from doing this strategy. So what you do instead is you stick to one strategy, 1 or 2 of them that I've just mentioned, and just stick to it. If you're playing for a 2x, just lock in your profits. Just lock in and take your profits. Reposition and then do it again. Do not worry if it goes 50x because you're not chasing 100x on this. You're just compounding 2x 5 times. Because if you compound 2x 5 times, you then end up making a whopping 10x, because 2 times 5. Simple, quick maths. So then people come to me and go, oh, but Biss, it's not possible to do this in a bear market. Yes, it absolutely is, because I've done it. I've made over 6 figures here on a single Bitcoin trade. As you can see, my realized P&L, $49,000, unrealized, $34,000. And then I ended up scaling out of this position anyway. As you can see here on this same trade, $26,000, just above this entry here. I then ended up making 60,000 on this. So, and that is just off a small move down here in a bear market. And bearing in mind, please bear in mind, I only had 3,000 euros left in my name at this exact moment down here. In this moment down here, after FTX collapsed, I only had $3,000 euros, pretty much the same thing, to my name. And then ended up making over 6 figures in a single candle here. And the move is only 30%. So it absolutely is possible in a bear market. Also, on top of this, in one of my old 1 to 100K trading challenges, I took $1,000 and turned it into $14,000 in just 9 simple trades. And I did this publicly. And I'm going to show you something of a bit hindsight here, but you only need to hit 10 doubles to turn $1,000 into $1 million with the power of compounding your profits, because compounding is key if you want to grow your account. Now, of course, you're not going to hit them all back to back. You're going to have some losses and you're going to have some break evens. But I'm going to show you the quick and easy maths here, because you can play around with the maths. As long as you minimize and do not have large losses and you switch your losses for break evens here, then you have a lot more success. And that's what I did it in my last 1 to 100K trading challenge. So here, start at 1,000. You hit 2x to 2,000. You hit another 2x, 4,000, 8,000, 16,000, 32, 64, 128, 256, 512, 1 million. And look, when you're playing with these bigger numbers down here at 128, 256, 512, it doesn't matter if you hit another 2x or not. Because even if you just make 40% on 100K, you've made $40,000, which is a very good trade. And it is more than anything in this category here. So all you need to do really to make a significant difference is to make 5 2x's in a row, to make a massive significant difference in your portfolio. And that's all it takes really. Then you can start to play around, because obviously your portfolio is a lot larger, and then you can take the less riskier trades, etc., etc. But it is the true power of compounding, because you can take bigger risks, size up, and grow your portfolio this way. Because in crypto, the setup doesn't change, only the size. And just shortly, I'm going to go through the setup to find 100x. Because the same coin that you bought with $1,000, the next time you buy it with $10,000, buy with $10,000, you will just make 10x the money, because you put in more size. So only position size matters at the end of the day for the amount of money. But if you do not have a large position size here, then you need to earn the right to have a larger position size. And that's how you do this. And then most people pull their profits too early, or they get 1, 2, 3 trades right. They think they are the dog's bollocks. Then the next one that they do, they're emotional. They think they're the dog's bollocks. Then they make another mistake. So if you want to make life-changing money, you just need to wait for the best setups. And when the right market cycle comes around, that is when you strike. And for me, the best trading setup here is when, let's say, a coin launches. It then has its pump. You may not catch the first pump. It then comes down. For example, Bitcoin pulls back. It's weak. It's figuring itself out. Then it ranges in this area. Then when it breaks out and retests here, then it will have its mega rally. Okay, so this is just a typical market cycle here. You get the pump, you get the euphoria, then it comes back down, and then you go back into stage 1, and then it happens again. This is the best setup here. And I'm going to show you this on coins now. So this is a really old coin. And as you can see, this is that exact setup. You get that initial launch, euphoria. The market then pulls back. It goes into a consolidation area here. Then you range at the bottom. Then what happens is it breaks out of the range. You retest this area here. Then you get the mega pump up into new highs. This coin here ended up doing a 45x from that breakout of that range. And you can also go back to the same on Pepe. Here, exactly the same. You had this mega pump on old exchanges here. You had a big pump up. It then got launched on Binance. Then you had a massive dip. It then went into this same accumulation range here, there. Then once it broke out of this accumulation range, that is when you had the big pump into new highs here. So this same pattern where it pumps, it pulls back, it goes into an accumulation range here, and then once it breaks out of this accumulation range, that's when you get your 100x, maybe even 2x setup. And that is the setup that you need to look for on a lot of these coins. That is the best setup in order to make a lot of money. So which exchange should you use? If you don't want to have any KYC, then use Blowfin, check the description below. If you want to use KYC, KYC means that you know your customer and it requires ID, then use Bybit for trading and then Coinbase for spot only. Bear in mind, the fees are large on Coinbase. If you want to enter the decentralized network and buy coins like this, obviously don't buy this one now. It's absolutely dead. It's already had its pump and it's just bleeding off and off and off. So do not touch this one. This was an old one when the narrative was hot and a lot of people were talking about it. Then you can use Phantom Wallet and connect that Phantom Wallet to decentralized exchanges. And you can also use multiple exchanges as a security measure and protect your capital. So when you're on these exchanges, how much leverage should you use? And you can use trading setups for the compounding accounts. And as I said before, less is more every single time when it comes to crypto, because crypto is already volatile enough. High leverage will literally make you poor if you do not know what you are doing. Because as I said, position size is all that matters. 1 to 3x leverage is good enough to grow an account. It's all I use on a 1 to 100k trading challenge. And I went from 1k to 14k in 9 simple trades. You can use leverage to start, but once you are big, reduce the risk. You would only use leverage at a very small account size that you don't mind losing. Let's say $1,000. You don't mind losing $1,000. So you would use leverage on this to trade. But once your account is larger, let's say you have $100,000 now, you don't want to keep that full $100,000 on an exchange. So what you can do is you can put $10,000 on that exchange and use, let's say, 10x leverage to get to $100,000. And then you keep your other $90,000 safely in another asset. So therefore, you are just using the leverage as a hedge against your other money here. So let's say if you're trading, you want to trade with 100, but you do not want to use the full amount of risk, then you can use $10,000, let's say with 10x leverage. Obviously, then you are protecting your capital. But let's say if you use 1x leverage, you cannot get liquidated. If you use 2x leverage, it only takes a 50% drop for you to be liquidated. 3x leverage is a 33% drop, 5x is a 20% drop, 10x is a 10% drop. So let's say if you did do that example I just shown you with $10,000 in the account and price drops 10%, you would lose that full $10,000, but you will not lose the rest of the 90. That's why you use the leverage to protect it. But what you do not do is then go, I have another $90,000. Maybe I use 10x leverage for that. And now I have $900,000. That's not how leverage should be used. You can use that in a very, very small account scenario because it doesn't matter if you lose $1,000, you can just make it back from your job next month. If you lose $90,000, that's a bit more of a problem than $1,000. And then all the way down here, these are the numbers on the screen right now. 100x leverage, it only takes a small 1% move for you to get liquidated. For example, let's go here. This is the Pepe on the weekly time frame. So this is Pepe on the daily time frame. Let's go to the 3-minute chart. And imagine you're using 100x leverage. You enter long here because you think it's going to be a good trade. It would only need to go down to here for you to get liquidated. And look, it's already moved 0.4%. So you would be halfway to your liquidation. You can see it flicking now on the 3-minute time frame. That is 1% for you to get liquidated on 100x. So let me zoom out now on the daily time frame. That is all that you need to do to get liquidated. It's a very, very small move here in comparison to the rest of the chart. Like, as you can see now, I'm zooming out, this is tiny. So you need to be very careful with high leverage. You do not need it in crypto because the moves are large enough. And if you look at the historical liquidation probabilities for a Bybit account that uses leverage, if you use 100x leverage, there is a 94% chance that you get liquidated in 8 hours. That is the statistics of people using 100x leverage. If you use 5x leverage, the statistics of you getting liquidated in 8 hours is 0.09%. Very, very slim. That's just in 8 hours. If we slide across here, for you to get liquidated using 100x leverage in a 30-day period, you have a 97% chance. Using 5x leverage, you have a 13.9% chance. You've significantly reduced your chances of getting liquidated using less leverage. And that is using 5x. I'm telling you to use 1 to 3x because that's all I use in my 1 to 100K trading challenges. So if you can do better results than that consistently and keep the money, sure. But if you haven't, then no. Trading is actually very simple, and I'm going to break it down here for you right now. Longing simply just means that you're betting that price is going to go up. You buy low and then you aim to sell higher. Shorting means that you're betting price will go down. You sell high first and then you promise that you're going to buy it back lower later to make a profit. Or you promise that you're going to buy it back in the future. Whether that price goes up or down, obviously doesn't matter. And obviously here, there's your entry price, there's your stop loss, there's your take profit. Entry price, stop loss. On a short position, your stop loss is above your entry price and then you take profit down here. That's as simple as that. Now, many people put it this way. There's your entry, there's your target, there's your stop loss. You want your target to be a lot larger than your stop loss. You want your stop loss to be smaller than your target. A stop loss is in order to protect your capital. So you set it with your broker or exchange that automatically sells your position when it drops to a certain level. And the aim here is to limit your losses. Also, there is something here is you're not just limiting your losses. Many people will say this, but you also only use a stop loss when you are wrong on your idea to protect your losses. For example, you want to buy support. So you buy support here. You allow it to go below it. But your whole trade thesis was buying support. If support breaks, then you should have a stop loss below that support in order to stop you out of your position because you were wrong on your idea of supporting price. That is the whole purpose of a stop loss, where you are wrong on your idea and to limit your losses. So you don't just put, I want to take a trade here and I'm going to have a stop loss here because I want to limit my losses. No, you're going to lose a lot of money that way. You only use a stop loss when you are wrong on your idea and your thesis on your trade. And obviously you buy Bitcoin at $60,000 and you set a stop loss at $58,000 and then Bitcoin does fall to $58,000, your stop loss is triggered and protecting you from bigger losses if it keeps falling. Let's say if it continues through, and obviously the same is for a take profit. You buy Bitcoin at 60,000 and you set a take profit at 66K, it then pumps to 66K, you then lock in a profit of $6,000 per coin. And it helps remove that greed, as I mentioned earlier. So if it does pump and you want to keep raising your target higher, then it prevents you from doing that. Now, there are two ways to enter the market. There is market buying. This is when you just buy immediately at the best available price. You just hit the buy button and it fills your order instantly with other people on the order book. Now, you may just because you want to be filled instantly, you may pay a higher price for it, but you get instant execution and you own the coin immediately. It's good for fast moving markets when the liquidity is very high and there are a lot of buyers and sellers actively buying and selling in the market and the volume is high, therefore you will probably get filled at your entry price when you need to get in. Now, the cons of this is that you can get slipped, which means that, let's say if you buy here and then you get slipped, you end up buying here if the liquidity is low. And then if you want to market buy with big size, you may end up pushing the price up because you want to buy here, but there are not enough buyers and sellers here. So you do a big buy, the market will push up in order to find sellers to sell that coin to you. Because obviously if you want to buy a coin, somebody has to sell it to you. So then it pushes you up into this area here. So that's the only problem with market buying and selling. Then the other is limit orders. I don't really like limit orders for a reason I'm going to explain shortly, but you set a specific price where you want to buy. Let's say the market is here. You want to buy the support. Let's say this line here is the support. So you set a limit order here, stop loss below there. It comes down into here and then your limit order gets filled. Then obviously it goes up. You didn't have to do anything. You didn't have to be at the charts. You didn't have to look at the charts. It will just fill you, stop loss there, continue higher. I don't like limit orders and it will actually fill you in at this area here and you will not get slipped. If you're patient and you want to buy a dip, then it's good. But there's a con here. There's absolutely no guarantee it's going to fill you because price could just do this. You set your limit order here. Price could just do this, comes down. It doesn't actually fill you and then goes off without you anyway. And in super volatile markets, let's say if it just does dump down in one candle, it may not fill you and then it goes off without you because you're just trying to save on a few dollars rather than market buying here. Okay, what's that little amount there? So I don't like to use limit orders because I like to discretionary trade. For example, when price comes down into this buy zone here, maybe I don't like how price is reacting in this buy zone. Therefore, if I'm away at the charts, I do not want to be filled on my position. And so then it could just keep blasting straight through. Therefore, I just take an unnecessary loss when I could have just been at the charts. That's me, because I like to be at the charts. I like to monitor the price as it happens, and I get a better win rate by avoiding these losses like this. So if we want to trade, how do we win? How do we use previous price action to win at trading? Because everyone says it's really complicated when it's really not. Everything in life stems from the fundamentals. Then we add our spice and flair when we get really good. For example, in football, I'm pretty sure everyone here knows football. There is no point in how to boot a ball and bend it like Beckham, like a free kick, if you literally cannot pass a football. If you cannot pass a football, there's no point in trying to take free kicks like Beckham. And it's the same in boxing. If you are just swinging, throwing haymakers, there's no point if you cannot throw a jab. So if you cannot identify where price is going to have the largest reaction, then you really shouldn't be trading. Otherwise, you run the risk of entering a position and just getting chopped up by opening and closing his trade, etc., etc. For example, I want to know when price comes into my level, it's going to give me the largest reaction in order for me to make the most amount of money. Now, I could get in here and make a little bit of money in here, but it is a lot easier for me to identify this move here and sell up here. And I'm going to make a lot more money for it. I have to do less work and I make a lot more money from it. And I do this by picking the levels with the biggest reaction in price. So how do we do this? We spot previous levels that have pushed price away in both time and distance. These are the two key things here. Time and distance. Levels that have pushed price away in time and distance. And this is why it's number one, because we can predict the largest moves in the future and make the most amount of money with the least amount of work. Instead of just staring at the charts 12 hours a day, all we have to do is identify 3 to 5 key levels and then wait for price to react. And then when it does react, that's when we execute. For example here, on this chart, the largest moves have come from the arrows on the chart. Excuse this one, but that is the initial setup of this. We got a reaction off this. Once price pushed up here, we spend time and distance away from that level. Look, you can see time and distance. Then we come back down to retest it here before we got another pump. And then we spent time and distance away from this level. So if you longed here, you would get a big reaction in price. Then price comes down. We didn't get a big reaction here. It then comes down, but we get a big reaction from support turning back to resistance. We then get time and distance away. Then price is pushed away again in time and distance, and then comes back here for another big reaction down, another large mover in that market. The same on this chart here. This is the initial push that pushes price away in time and distance. It then comes back down, support here. It then pushes price away again in time and distance. We then squeeze below and get back above. Then we push price away in time and distance, a very good opportunity to long. Again, we push price away in time and distance. So let's say in this example here, you wanted to set a limit order here. This is why I don't take them, because you set the limit order here because obviously it's pushed price away time and distance. Then it just blasts straight through and stops you out. That's why I don't like the limit orders. That's me personally. But then once we do the opposite, we then spend time and distance on the underside. This support, 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 then turns to resistance, where we then have another large move and spend time away in time and distance. Then we just front run it before the big drop there. So there's two things to note with the levels. As you can see, we spent a lot of time and distance away in that first pump, and each pump after has a lower high, and then lower high. We actually get smaller reactions each time that level is tested. This means each time a level is tested, it doesn't actually make it stronger. It actually makes it weaker, because if this level was really good, it should push it away and keep price away, and then we shouldn't come back down to it. So I don't like to keep buying a support level at least 1, 2, 3 times. That is usually me done. I don't like to buy it a 4th time. In this instance, it did work. However, I don't like to do that. I may have taken this trade with a lot less size. So the more touches a support and resistance has doesn't make it stronger, because check this one. Once support, 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 support has broken cleanly like this, and then spends time and distance away, then once it's tested as resistance, this first touch is always the strongest reaction. as you can see, it pushes price away in time and distance again. And if you wanted to short this level, you would have got a very good trade out of this. So then once price comes back up to here, you then take it again for the second time. I actually did take this trade, and then price pushed away again. So this is super key in trading crypto, because this is where you're able to predict the largest moves using the reasoning as I mentioned earlier. Let's say if you wanted to buy the best support level, you would enter at the support level and you would have your stop loss below it. Therefore, you would make a lot of money. But once you have made a lot of money, you want to protect it. So how do we avoid scams and giving money to people? There are a lot of impersonators. So scammers pretend to be trusted people on things like Discord, Twitter, and YouTube. So even if somebody has the same profile picture as somebody, you should always do your due diligence on DMs. So real traders, influencers, and projects will just never randomly ask you for money. So scammers pretend to be trusted people on Discord, Twitter, and YouTube. So even if somebody has the same profile picture and name, do not trust the DMs. So the Discord scam is where people try to copy your username. For example, my name is BISBTC. They will swap the I for a number 1 and then message people, and the people on Discord will assume that it's me because it looks like BIS when it isn't. So always check that you've got the correct username on Discord. It's the same on Twitter. My username as of today is @BISBTC. So do not reply to DMs unless it is me on Twitter @BISBTC. And then obviously my only Telegram is the one in the description below. If you want to join my real Telegram, it's in the description of this video below. And then there is a YouTube scam where some people comment below on there saying, "This is my seed phrase, da 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 da." Do not engage with those kind of people. I think YouTube have cracked on it down. Also, there is something that people do. They put fake tokens in your wallet. You might open Phantom or any of your crypto decentralized exchange wallets, and you may see a random token appear. I don't like to touch them. Just do not touch it. Don't sell it. Don't try to move it. Do not interact with that token at all, because it's often a trap to get you to connect to a scam website and takes all of your money off that. And it's going to happen if you have a large wallet. For example, here, these are just people just airdropping me random tokens here into my wallet. And they don't, look, the amount is tiny. It's like 96 cents, 92 cents. There's no point in trying to sell that. You can't even buy a coffee with 92 cents. So yeah, you might get like a whole bunch of coins in your wallet. Just do not touch them. Only touch your main ones, and so on and so forth. There are rug pulls out there. As I mentioned, $1 million market cap, there are a lot of rug pulls. A project hypes up a coin, everyone buys in, and then the team dumps all their coins and disappears. And I'm gonna show you what it looks like in a minute. Now, a lot of people recently have been saying any coin that pulls back is a rug pull, and that's not true. That's not true at all. Because if you build a coin on Solana or ETH, and ETH pulls back, or ETH and Sol pull back 70%, then the project is gonna definitely pull back 80-90%, because it is built on ETH. You cannot have a project. It's very, very rare, a super rare example that a project built on Solana or ETH, and Solana and ETH have dropped 70%, that this coin built on that network is only down 60%. It is literally impossible, nearly impossible, because they usually use the tokens in order to balance out the pool. So if Solana drops or ETH drops 70%, then these coins are also going to drop the same amount. That does not mean it is a rug pull. So a lot of people nowadays just go, it's a rug pull, it's a rug pull, it's a rug pull. A rug pull will really look like this, or it looks like Luna. But there are some things you want to check. Is the liquidity locked? Are the developers real and known? Does the project have real backers? If it feels rushed or sketchy, just stay out. It doesn't matter if it pumps. So there is also honeypots. This is where you can buy a coin and you cannot sell. You get trapped while insiders just dump on you. So always check your contract, your token contract, before buying unknown tokens. For example, as you can see, this is a honeypot and a rug pull. The honeypot means that anyone can just buy it. It just goes up only, up only, up only, and then the tokens and owners have just dumped it in one candle. So that's called a honeypot and a rug pull. So once you make money and then you protect yourself from scams, then you need to change your focus, because if you hit 6 figures, you can reduce your risk. There's no need to put in excessive risk here. Obviously, if you want to put in an excessive risk, that's absolutely fine, but you do run the risk of losing that 6 figures. If you are okay with that, then that's down to you. Just know that if you put in excessive risk, that you do run the opportunity of losing that money there. And then if you do hit 7 figures, it's a completely different game. And the same with 8 and 9 figures. So if you do hit 7 figures, for example here, 5 million, you make 20% in a year. You then have 6 million, which means you made 1 million in a year by just making 20% profits. Or what you can do is just simply hold high caps like Bitcoin. Let's say if you have $5 million, for example, you could put $4 million in Bitcoin. Then you can have another $900,000 in rotating into a layer 1. Then you have the rest $100,000 that you can actively trade with and do things with. But this way, your biggest risk is $100,000 as per my simple proposed structure here for a portfolio. You have your liquid spot, BTC, then you have your trading amount and 10%, then you have your 8 fund, which is $100,000. So you just play around with the amounts depending on your portfolio size. Or what you can do is move into other areas once you have made a bunch of money to protect your capital, because there are tons of ways to protect your money in today's world. I had a student of mine, he wanted to invest in properties in Dubai, and that's exactly what he did. So he made a bunch of money with me and then invested in properties in Dubai, and then he kept money inside the markets as well. Or you can move your money into other areas once you have made a lot in crypto. You can move your money into property, you can start to diversify your portfolio into other categories other than just crypto alone. But you would actually never learn these lessons unless you were with someone with more experience and they tell you these lessons, because they've been through these lessons before you have. Because each time you climb to a new level, there is another devil you need to master, because everyone thinks it's just, oh, I must just make money and it's easy. But once you have made money, you need to switch and pivot, as I've mentioned here. And you do not have that experience yet unless you have already made a lot of money in the first place. Because even some of the greatest investors of traditional markets had mentors and people advising them on their positions. Look, whether you are like this guy or not, it doesn't matter. I'm just using this as a key principle because he's made a lot of money in the markets, and that's George Soros. He had an advisor, Scott Bessent, and Scott's role was to advise George Soros on the one trade that helped break the bank, or nearly broke the Bank of England. And this was back in 1992 when the Great British Pound nearly dropped a significant amount in a day, and it was one of the biggest trades of all time. Obviously then Scott became an advisor to Donald Trump, who also has advisors. And then you have one of the best investors of all time, Warren Buffett. He had an influential mentor, Benjamin Graham, that taught him everything and calls him the father of investing. And he was also made the book, The Intelligent Investor. But even Warren Buffett had a mentor along his journey to get where he is. So there is not a single person on the planet that didn't have a mentor. And I would argue the fact that it was important that they met these people at the right time on their journey, because if Warren Buffett continued learning the incorrect stuff throughout his investing career, then he would not be the same investor as he is today if he didn't meet the right mentor along the journey. And that's exactly where all of my students are at today in their crypto journey, all because they simply copied me this crypto bull run. So they started with me, had a small amount of money, turned it into a large amount of money, and then they are looking to invest their money into other areas and diversify their portfolio to cement their financial future forever. So if you would like to skip all of the hard work and take the exact same trades as me and buy the exact same tokens as me and produce results just like my students, like Faisal here, he's up $1,000 with a $5,000 investment on one single trade. Novello here, she had some incredible 6-figure profits just starting off as a complete beginner and was able to make 6 figures in profits. And she went from being in debt and now debt-free with over 6 figures in profits. And as you can see, Kai's in here. He did the 1 to 100K challenge, which he completed in 3 to 4 months. And then he stayed inside, and then he's up 7 figures. The same with Mrs. Chips here. She's reached her 7-figure goal. Victoria here, she also has a 6-figure balance in her wallet. Same with Princess Girl here. She hit over $1 million in balance. So I've produced results like this time and time again and produced countless millionaires, all inside my 7-figure mastermind. So if you would like to simply copy the exact same trades and buy the exact same tokens as I'm buying through my guidance and mentorship, this bull run, then you need to check the description below and apply below. From there, You just have to fill out an application form and I will get back to you to see whether we are a good fit or not, because I don't take everyone on board. So that's it for this crypto course. I hope you enjoyed it, and I'll see you all in the next one.